Hey, how's everybody doing today? Hit that Q&A box. Let me know you can hear me real quick, please. Yep. All right, Justin. Thanks. Hey, Jan or Jan. I don't know. Secret Age Man. Thomas. Thomas. Okay, friends. Well, holy moly, we've got great stuff to talk about here today. Um, we're going to talk about best trade execution techniques. And that is super important stuff. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. And happy Fat Tuesday. For those of you who are not familiar with me, allow myself to introduce myself. My name is Dan Passarelli, and I've been around the block for a long time in this options game. Wrote 3 books now. One is not quite out yet, but it will be out within the next 2 months. Oh my gosh, 2 months. You believe it? But 2 of them are out, and one of them is consistently ranked in the top 5. That's Trading Option Greeks. I also write a great deal on my Substack, which is Wealth Building with Options, which is the same name as my podcast, Wealth Building with Options, for those of you who listen to podcasts. I'm also a trader, traded professionally on the floor of the Chicago Board Options Exchange when I was a younger man, back when I was a younger man. But now I still trade. I traded my own accounts, retail accounts, just like you. And that makes it easier for me to help you because I do the same things that you do. I'm also the founder and president of Market Taker Mentoring, chief content officer as well. Market Taker Mentoring is the global leader in option trader education. We've been helping traders reach their goals for 18 years. We are actually currently accepting applications for one-on-one coaching. You just go to markettaker.com, scroll down to the bottom and fill out an application. It's in the footer of the website. I collaborate with all the good actors in the options space, the top options friendly brokerage firms like Firstrade, as well as all the exchanges globally as well who are involved in options. And I do other things besides trading and investing. Got to have other things in your life. And the important stuff like family. I'm a family man, married to my wife, Kathleen. Many of you know Kathleen. She runs operations here at Market Taker, takes white glove care of our one-on-one coaching students. I got my 2 adult children who live together in Chicago. And I got my 2 little runt dogs. Every once in a while, one of them comes and sits on my lap during the presentation, but I don't think that's going to happen today. And besides that, I run, I'm a foodie, do a lot of traveling, got a trip coming up in 5 weeks. Oh my goodness. And I'm a music person as well. Okay, enough about me. Let's talk about the important person here. Let's talk about you. I'm going to give you everything I got today, everything I got to help you be able to execute your option trades more effectively, more efficiently. And so I want to give you some other things besides just what we're going to do here today. I'm going to give you some free classes. And all you have to do is go to markettaker.com, which is right up here, markettaker.com, and go to the top right, join free. And that's where you get a lot of great stuff. Now, in order to understand how to execute trades, we've got to understand the role of market makers, uh, also called dealers. But back when I was a market maker, they didn't call them dealers. So I still call them market makers, but you can call them either. So when you, well, we'll get into that. Okay. So market makers and competition. First of all, who are market makers in competition with? Huh? Who can tell me? Who are market makers in competition with? Anybody? No? Nobody? That's right. It's market makers with each other. I was waiting for somebody to say me or us, but that's only got a sliver of truth to it, just a sliver. And we're going to talk about that. The good thing though is they are fiercely competing with each other. And so that means, like any other business, the more competition there is, the better it is for the consumers. And we can think of ourselves as the consumers. Market makers are kind of like the wholesalers or the stores, I guess, really. No, they're the stores. Um, so we end up with tighter bid ask spreads because that is the only thing we're competing against the market maker on is the width of the bid ask spread. That's how market makers make their money. That's an expense to us. Um, all that being said, why are we not competing against a trade? How come when I go into the market and I buy calls, well, it's the market maker on the other side of there. why do um why do when we go into the market and buy calls, isn't the market maker the one who's selling us those calls? Yes, the market maker is the one selling us those calls. So doesn't that mean that we have a long position, they have a short position, so one of us is going to win and the other's going to lose? No, because market makers delta hedge all their trades. And so when we make a trade, we don't delta hedge. So like the stock could go up, and because market makers hedge, they could still make money and we can make money too. So the only thing we compete against market maker on is the bid ask spread. So more competition, the better. Tighter bid ask spreads, also more innovation. Now, obviously, almost all trading is fully electronic, online. And so market makers innovate and try and get the best technology so that they can beat the other guy or gal. And they're more accommodating to customers of the exchanges, who is who? Kind of us, right? Also, brokers, arguably, and more concessions for traders on the exchange. Okay. So when it comes to standardized options, what are we talking about? Standardized options. Aren't options options? Well, yes and no. Listed options are listed on an exchange, like the CBOE or the NYSE or the Boston Options Exchange or the Miami Exchange. But they're all standardized and fungible. Fungible means, what's a good definition for fungible? Fungible means basically I could buy a call on one exchange and sell it on another exchange because they all have the exact same specs and they're interchangeable. Wait, Isn't that true of all options? Well, no, technically there are some that are traded over the counter. Homogenous is a good that's a good synonym too. Yeah, thanks, David. Um some are traded over the counter, and those are more like bespoke options. Um created in a very specific way and not really fungible. When you open that one, you open it with another party, and you pretty much have to close it with that party. And all the trades are backed by a clearing firm to guarantee against default. Because what if somebody crazy and reckless? Is there anybody crazy and reckless in this class with their trading? I hope not. Not if you've been attending my classes. We don't like being crazy and reckless. We like consistency, right? We like trading a plan. But let's say there's somebody who's crazy and reckless, and they were just allowed to go and sell 1,000 calls on Micron in their $5,000 account. And then Micron shoots up 10% in a day, as it's known to, maybe 15%, 20% in a week. And all of a sudden they get a margin call for like $5 million. And they say, what? I mean, my account's $5,000. I'm just gonna opt out of paying you $500,000. Stick it. And then the broker is on the hook. And if the broker is in trouble, then the clearing firm is on the hook. And if the clearing firm is in trouble, then the OCC, the Options Clearing Corporation, which is the central clearing firm, is on the hook. And if they're in trouble, holy cow, I don't even know what to say. That's never happened yet. Hopefully never does. Now, because these contracts are all standardized, they're all very liquid. Let's talk about liquidity. What is liquidity? I planned ahead here. I've got a definition. The ease at which an asset can be traded without affecting its price. Damn, now that's a good definition, isn't it? That's a really good definition. And how does that happen? Or what am I even talking about? How does trading an asset affect its price? Supply and demand. Back in my day, we used to take economics classes in high school and learn about supply and demand. Now they don't want our kids to understand economics, but they should. Supply and demand means what? It means if I buy something, there's a certain amount of supply there, and there's a limited amount of supply. Everything in the world is limited, right? Limited amount of supply. So if there's more demand, the price needs to go up because you can only supply so many at this price and then sell more at this price. Sooner or later, you run out of it. So that's what I'm talking about here. When there's a lot of supply and a lot of demand, now supply and demand can absorb one another. And because options have many strikes and many expirations, you can trade spreads. Buy one call, sell another call at a different strike or a different expiration. That just adds to liquidity. Liquidity is a funny thing. It's really a very interesting thing to talk about. But liquidity begets liquidity. So when people are spreading and such, they're trading more options, which means because there's more options being traded, it becomes more liquid. But there's a limit to it. Because think of any given stock, they might trade X number of shares a day and might have a market cap of X or whatever. But there's a whole ton of options listed on it. So the notional value that can be potentially traded, which is just a fancy way of saying the kind of like the market cap, kind of, that can be traded in options is massively bigger than what can be traded in stocks. And so that affects liquidity too. So we need to have someone who's responsible for providing liquidity. And those are market makers. And they're only able to do their job because they spread their risk. All right. So who are market makers? Well, people or firms. Now, these days, they're all firms that quote bids and offers and options. Verbally announce an open outcry or electronically disseminate. Yes, there still is open outcry trading. Should have put a picture. Every year for quite some time now, we've been doing a mastermind where we take our top students to the Chicago Board Options Exchange for a 3-day, very intensive class. And we always have incorporated a tour of the trading floor in that. So there's always a gratuitous picture we take. I should have put one of those up there because there's a lot of trading that still happens in that trading pit on the Chicago Board Options Exchange, and the Boston Exchange has one. The Texas Exchange has an open outcry pit. I believe the Miami one also does now as well. So there's still a lot of that. It's mainly in the indexes and such, though. Nowadays, most is just electronically disseminated. When you look at an option chain on your Firstrade account, you see all those bids and all those asks. Well, Firstrade didn't put them there. Firstrade's just passing along that information to you. They're saying, look, you can buy, here's the bid, here's the offer. This is the best offer. This is the best bid somewhere in the world. That's the best offer somewhere in the world. Market makers are disseminating those prices, and it's going to be the same at every brokerage firm, basically. Market makers also have privileges and obligations. They have privileges of direct access to the exchange. Me and you, we don't have direct access to the exchange. We have to go through a broker. We have to send our trades through Firstrade because Firstrade has access too. The brokers do. Brokers and market makers are the only ones with access to the exchange. And because they have access, there is no commission. There's just small exchange fees, which we pay also. We have to trade through someone who has access, who's called a broker. And market makers also get very favorable margin requirements. When I was a market maker, I was literally I remember in Ford Motor Company, I had I forget even how much it was, $100 million worth of Ford stock or something crazy. And I didn't even have a directional position. That was just because of my hedges. So we were trading with a great deal of margin. But in addition to privileges, you also have obligations. Sometimes you must give a quote. Now you might be thinking, well, why wouldn't a market maker want to give a quote? Well, because, every once in a while, every few years, there's this something crazy in the market happens and nobody wants to stick their neck out, and market makers stick their necks out for a living. And so that's part of the deal, is they're forced, they're the quoter of last resort. Got to keep those markets open. So we need the market makers and we require them. They're obligated to quote. And they have to have certain capital requirements too. Okay. So why does the market maker trade? To provide liquidity, right? Well, kind of. It's kind of the byproduct, really. Think of a business in your town. Why are they in business? Why is the dry cleaners in business? Well, they're in business because they feel a moral obligation to clean our shirts, right? Well, no, they're in business to make money. But cleaning shirts is the service they provide. Just like mark makers, they're in business to make money. The service they sort of inadvertently provide, or I guess I'd say unintentionally provide, is liquidity. They create liquidity by taking the other side of orders that come into the exchange. And so it looks kind of something like this, right? Got that really way at the bottom of my screen here. So the way market makers do this is they quote a bid and an ask. And they quote a two-sided market. Market makers are going to say, I'm 457 bid, offered at 460. And that could very well be the same market maker on both sides of the trade. Could be the same market maker saying, I'll buy it at 457 and I'll sell it at 460. What do you want to do? And, that's like some slightly in the money calls here. The puts, I mean, those are a penny wide. This is an SPY, which is about the most liquid thing out there. So market makers are really, what they're trying to do is buy the bid, sell the offer, buy the bid, sell the offer, and lock in pennies. They tongue in cheek refer to it as picking up pennies in front of a steamroller, because sometimes they can end up with a bigger position than they intended. And that's when everything goes wrong. Of course, Murphy's Law of trading. So market makers are trying to make smaller profits, just over and over and over again, as much as they can. They're not trying to make less money. They're in the business of buying bids and selling offers. That is small profits per contract, but they just trade a lot of contracts. A lot of contracts, a lot of transactions. Okay, so brokers execute orders electronically, and they display literally hundreds of thousands of bid-ask quotes automatically. When you log into Firstrade, thinking about trading whatever options, Apple or NVIDIA or whatever it is, you go to their option chain, and there's a whole bunch of expirations, there's a whole bunch of strikes, there's calls and puts, and they have that for all the stocks out there. So there's just massive, massive amounts of data. People don't really think about that, but it's massive, massive amounts of data. Okay. So when we send an order to the exchange, first thing we do is, well, we're in our house or our office or on a bus on our phone, and we create an order, and we on the Firstrade account, right? We log into Firstrade. We say, okay, I want to buy these calls, sell these puts, whatever it is you're doing. And you click the offer on your Firstrade account and you send the trade. Where does the trade go? Well, it goes to Firstrade. And then after it goes to Firstrade relays it ping, to the Chicago Board Options Exchange or the ICE or the New York Stock Exchange. They route it to an exchange. If your offer is the same as the market maker's bid, or vice versa, your bid is the same as market maker's offer, a trade is consummated, is how they refer to it, which is kind of weird. If it does not match, maybe your $1.75 offer and the bid is $1.65. It's entered into the market as what we call resting order, or I guess maybe more accurately, a limit order. And it just stays there until the bid does match your offer. And then we have what is called the best bidder offer, or the national best bidder offer. And what that is on think of a stock. What stock do we want to use? How about Ford Motor Company? Gosh, I haven't looked at Ford in a hot minute. What's Ford's price? $14. It's been around $14 for about 20 years. Jeez Louise. Oh, that's interesting. This kind of, I forgot about this, and it kind of reminds me of something that's been on my mind already. It's kind of nice on Firstrade. They got this different valuations, and it tells you what sector and industry it's in. And they even give you a fair value assessment, which is pretty cool, isn't it? That's pretty cool, man. Okay, so anyway, let's put that aside for now. So all the market makers in Ford, maybe on the SIBO, maybe there's 7 market makers who make markets in Ford. And then on the New York Stock Exchange, maybe there's 5. And on the box, maybe there's 2. And on BATS, maybe there's 5. Well, all of them on one exchange are competing against each other, but all the exchanges are also competing against each other. So they're all competing against each other. They're all generating their bids and offers. And then there's those resting orders, or those limit orders that maybe you put in, or some retail trader put in, or some hedge fund put in. Well, those are also part of the market. And the best, highest bid in the world at any given moment in time, and by moment in time, I mean like millisecond, and the lowest offer at any given moment in time, that makes up, when we aggregate all of them and find the highest bid and the lowest offer, that makes up what's called the best bidder offer. Very, very clever, creative naming convention here, isn't it? I don't know how they came up with that best bidder offer. I actually call it the national best bidder offer, even though it's, I think, technically global best bidder offer these days, but they call it the national best bidder offer. And that's what it is, just the highest bid on anywhere in the world of all the market makers and all the limit orders. And by the way, whenever you look at a bid and an ask on your brokerage screen, your Firstrade screen, you can bet your bottom dollar that it's almost always going to be a market maker. Every once in a while, it's a non-market maker order, but mostly it's market maker orders. We can get into how to do that, but how to tell, but okay. So the market, which is the bid and the ask, is 285 at 295. Let's say somebody here, Steve, decides to offer this option, whatever it is, at 290. Well, now the offer is 290. You'll see your offer in there as part of the market. All right, so let's talk about the role of market makers here. So market makers may make large individual trades and thus accumulate large overall positions. Because look, when somebody like Tomas goes into the market, I don't know, maybe Tomas is a shooter. What's your average contract size? Depends on a lot of factors, of course, right? You probably trade 10 Ford options to every NVIDIA option. But I mean, Maybe if I'm doing my covered calls and cash cured puts and such, I typically send in like a 1 lot to a 5 lot. Okay, the market maker trades it and whoop-de-doo, they made $50 of theoretical value from me. But every once in a while, there's some player at Goldmine Sachs who comes in and buys 10,000 calls. Well, the market makers, they need to trade contracts because that's how they make their money, buying bid, selling offers, buying bid, selling offers. So they're going to take as big of a piece of that trade as they can. And, they might buy 500 or 1,000 of those calls or sell them or whatever it is. And then as soon as the market maker sells those calls to, the Goldman guy or whatever, what's the first thing that the market maker does? I think I just asked you guys this question within the last month, and it was answered correctly. They delta hedge, right? They hedge the deltas. Thank you. Yes. Hedge the deltas. So, what's the second thing they do? They hedge the rest of the Greeks as much as they can. Now, if the market maker sold 5 of these calls and, bought a couple hundred shares to hedge them, they're not super concerned about that short gamma or vega they have. But when Goldman comes in and buys 10,000 of these things and they sell 1,000 to Goldman or 2,000 to Goldman, they get their hedge done right away. And then they're like, oh, crap, man, I've got a lot of negative gamma and negative vega. If this market makes a big move or if implied volatility goes up a lot, I'm going to get it handed to me. I'm going to have to buy some options. And so what do? They raise their, hold that thought. We're going to talk about the Greeks first, and then we're going to talk about that thing. There are there are 4 main Greeks that market makers watch, and arguably there's a 5th one also that I don't have on here, Rho. Delta is typically the most important. Delta is the rate of change of an option relative to a change in the underlying stock or ETF. Gamma is the rate of change of the delta as the stock or ETF changes. Theta is the rate of change of an option's value relative to a change in time. And the only way time changes is it moves forward, can't move backward, unfortunately. And so theta just measures how much you make, how much value the option loses as one day passes. And then vega is the rate of change of an option's value relative to a change in implied volatility. Implied volatility, what's that? I'm glad you asked. Well, in options, there are 2 types of volatility. One is realized volatility and one is implied volatility. Now, as far as realized volatility is just exactly what you think it is. You look at a stock chart and the stock's whipping all over the place. You go, holy cow, this puppy is volatile. Well, yeah, you measure how volatile with realized volatility. It's the annualized standard deviation, technically, of daily returns in that asset. You might hear, in a lot of contexts, I like to use the term realized volatility, but you might hear people call it historical volatility also, or statistical volatility, or just the stock volatility. But implied volatility, that's, you guys ever watch the Rocky and Bullwinkle show? It's probably not on too many channels these days. I bet you can find it on YouTube though, right? And like every once in a while, they'd switch to a different subject and Rocky would say, and now for something completely different. Well, implied volatility is completely different, but it has some things in common. Implied volatility figure, here's like the textbook definition. It's the volatility figure that when entered into an options pricing model yields a theoretical value reflecting current market prices. What it basically is how cheap or expensive the option is. All else held constant. Sure, if the stock goes up or down, you make money on delta. Time passes, you make or lose money on theta. But the supply and demand feature, when Goldman comes in and buys 10,000, well, the market makers need to raise their price. They can't raise the price because there's so many factors that affect the price, but what they do is they raise the volatility. When they raise the volatility, that sort of normalizes the option price and says, okay, we're going to hold time constant, interest rates constant. We're going to assume the stock doesn't move, but we've got to make all these options in this stock, or at least this expiration in this stock, a little more expensive because I just sold way too many of them and I don't want to sell any more at this volatility level. In fact, I'm going to raise my bid so I can, cut my profits a little bit if I have to, so that I can buy some of these suckers back because, I got too much risk on. So they raise their implied volatility. And then, if they sold or if they bought like the March 60 calls on their bid, woohoo, first they hedge it, but then they want to sell the March 60 calls on their offer. But guess what? It's unlikely that somebody somewhere in the world is going to come in and sell it on their offer. Like they just can't sell it on their offer. Like I might have a car in my driveway that has a blue book value of $25,000 and I might want to sell it at $30,000. That's my offer above the value of it. Market maker would then say, and I'd buy another car like this for $20,000 because it's worth 25. So I might want to sell that car at $30,000. It's my offer, but like, who's going to buy from me? I got to find a buyer. I can't just sell it. I can't just call somebody up and say, buy this car at this price that I want to sell it. It's more than the value, but you have to buy it. Like, who has to buy it? The person would say, forget you, buddy. I'm not buying that car at $30,000. What are you, crazy? And that's what it's like being a market maker. They buy the bid, but if they're going to sell their offer, they got to wait for somebody somewhere in the world to come and buy it, for them to make the decision. Market makers don't act, they react. And so what they do is they raise their volatility. Well, like if the market maker sold the option, they raise their volatility so that all the options in that March expiration for that stock, all their theoretical values get a little bit higher. So their offers are higher, so they don't sell any more at that volatility, but they'll gladly sell some at a higher volatility. And their bids are closer to the offer so that they can buy some back. But they're not going to buy the same call back because it would just be a massive coincidence if somebody somewhere in the world just sold them and now somebody else somewhere in the world wants to buy them. That never happens. Typically, if they bought the 60 calls, they'll sell the 65 calls. About the 80 calls in September, they'll sell the 80 calls in June or whatever. They'll spread it. They'll spread off the risk to get rid of their Greek's risk. Delta hedging is the biggest thing. It spreads off the biggest risk. With me and you trading in retail accounts, our biggest risk is typically delta. Sometimes it's not the case. If we're trading iron condors or butterflies or something like that, it might be more of a delta neutral type trade. But it's still typically the biggest risk. Delta hedging is when we hedge or neutralize the delta of an option position by trading the underlying. And like I said earlier, like there's a time when I was, long or short, I don't even remember how much, $100 million worth of Ford stock. And those were just my hedges. Like that's very capital intensive. So the market makers typically delta hedges all their option trades. So like, let's say I buy 20 of the 40 strike calls that have a 50 delta. Well, 50 times 20 that's along 1,000 deltas, or 10, depending on where you put the decimal place. I like to do it this way because this is kind of like the equivalent of how many shares I'm long. And so then I know, oh, I'm long 1,000 deltas. So I'm going to sell short 1,000 shares. Now my position is flat. Hey, I'm going to buy 50 of these. Somebody sold me 50 of these 75 puts that have a 40 delta. Well, 50 times 40 is 2,000. Let's see. I was the person who bought the puts. So I'm short 2,000 deltas. How do I offset that? I buy 2,000 shares. And once I do that, we'll go to the first example here. My delta becomes zero, right? Because I'm long 100 deltas, short 100, or long 1,000 deltas, short 1,000 shares. But I still have gamma. I still have theta. I still have vega. So I need to reverse that. Long options have positive gamma, negative theta, positive vega. Short options have negative gamma, positive theta, negative vega. All right. So when spreading off non-delta options risk, I got to do that. First, I hedge off the delta, then the non-delta, then the theta, gamma, vega, and maybe even rho if it's a longer term option. Generally speaking, if I'm overall long options, I pretty much have to sell some. If I'm overall short options, I pretty much have to buy it. And that sort of demystifies and takes a lot of the complexity away from what market makers do. How do market makers reduce risk? Well, they prefer to close open contracts, but they usually can't. So they just get flat gamma, theta, or vega. If they bought these, this is market maker's bid. Let's say somebody in here, Justin, sells these calls to open a covered call position or something. Well, the market makers buy them. The market makers want to sell the 161 or the calls on the offer, the same calls on the offer, 6 cents higher, and lock in that profit. But someone somewhere in the world has to come and want to buy them. So they sell something else in order to, because if they're positive gamma, negative theta, positive vega, that means they're long options. So if they sell an option, their gamma is going to get smaller, theta smaller, and vega smaller. Okay. Is the market maker friend or foe? Well, here's the thing. Mostly their friend, but not entirely. They're a friend because they provide liquidity. If all the market makers staged a walkout, first of all, that would be weird. That would be really weird. I could not even imagine that happening. But if they did, every market maker said, we're protesting. The soup in the kitchen is terrible until you put more salts in the soup and less potatoes. I'm not trading. If they all walked out on the same day, you could not even trade. They provide liquidity. But because they hedge their deltas, they're trading volatility, not direction. And that's really gamma, theta, and vega. That's all volatility trading. And like I said before, it's possible for you and the market maker to win, or you and the market maker to lose, or one to win and one to lose. It is not a zero-sum game. Options is not a zero-sum game. And when I say that, there's usually about a 2.5% chance of somebody saying, Passarelli, you're wrong. It is a zero-sum game. How can you say that? And then I have to go and have a long discussion. So I'm glad that nobody can raise their hand right now and say, Passarelli, you're wrong. But the reason why it's not a zero-sum game is because market makers introduce stock into the equation. And stock is not a zero-sum game. The corporation could issue stock, people can buy it, and then overnight they can announce they have the cure for cancer, and everybody owns the stock, makes money. There's nobody short it. You could argue philosophy on that too, but so really all you're fighting the market maker for is you're battling for the bid-ask spread. Bid-ask spread is the market maker's profit, and it is our cost. Other than that, you could be BFFs with the MMs. But here's where you got to fight them a little bit. It's the only part of the trade that arguably is a zero-sum game, because the more above the bid you buy or below the offer you sell, the less your cost and the less market maker's profit. So there's some mechanics here. There's a theoretical value, or fair value, some people would call it. It's just a weird word too when we're, talking trading in markets and capitalism. The theoretical value is the price the market makers believe an option is worth. So they want to buy below the theoretical value and sell above the theoretical value. So that's where they set their bids and their asks. Set their bids below theoretical, set their asks above theoretical. Theoretical profit to market makers is everything. If their theoretical value is 2 and their bid is 190, their offer is 210, if somebody sells on their bid at 190, in a market maker's mind, they're like, oh, cool. I just made 10 cents of theoretical profit. Awesome. And, you hear 10 cents, like, oh, it's a dime. Well, yeah, but 10 cents of option premium is $10 of money. And, if that's 1,000 contracts, then, it's $10,000. This stuff kind of adds up. So the bid ask spread is the cost, and it's your biggest transaction cost. Some people are like, oh gosh, I got to call my broker and get my commissions down by a nickel. I wonder if they'll do that. Well, okay. You trade several thousand contracts in a year. It matters. It matters. But you learn to middle markets and cut down on this transaction cost, and it makes a massive difference, like a life-changing difference. So middling markets is not trading right in the middle of the bid ask, but it's trading between the bid and the ask. If you think about it, there's this theoretical value, right? Market makers will buy below it and sell above it. And they're usually pretty equidistant, the bid ask to the theoretical. So I know that if I want to buy it, I know I can buy the offer. And I know that I can't buy the bid because market makers are trying to do that, and the bid is still the bid. If the market maker thinks it's worth this, the theoretical value, they're not going to sell it to me for less than this. They're not in the business of selling things for less than they're worth or buying things for more than they're worth. They're in the business of the opposite. So if you're buying and you want to middle the market, you have to bid above the middle, but below the offer. And sometimes people say, oh, no, I get filled all the time trading in the middle. And if it's something really liquid, SPY, Apple, there's not many, but some of them you can get filled. It won't be always, but it could happen frequently. But usually what happens is they put in a bid or an offer, and then the market moves, and I think they're trading at the middle, but it's not the middle anymore. Possible benefit to middling markets is you could get a better fill price, which means this cost of slippage or this cost of the bid-ask spread has become lower. Possible detriment, though, is you can miss an opportunity for a desired price. Okay, so right now, theoretical value is $2. Bid at 190, offered at 210. I might put in a bid to buy at 205. And just then the underlying stock ticks up. And so because those options have a delta, now boop, price of the call goes up too. Now they're not offered at 210. Now they're offered at 215. Now I'm 205 bid. Oh, crap. Well, I'll just go up to 210. Too bad I didn't do that in the first place because I could have bought them at 210. That was the offer. And then all of a sudden, oh, the underlying ticks up again. Boop. Well, now the call's offered at 220. Ah, crap. I could have bought him at 210 if I would have just not messed around with this middling business. So it's really important to get good at this. Really important. And bad candidates for middling are single leg options. I don't know, secret agent man. That does happen. Chasing the offer, the bid, right? Yeah, it does happen. So bad candidates are single leg options because they have a bigger delta, or options on fast moving stocks. You know, busy day you're trading Micron, like you probably don't want to mess around with trying to middle the market. But good candidates are vertical spreads or wing spreads or time spreads or ratios, any spread that has a smaller delta. Because what is the market maker's biggest risk as soon as the market maker makes the trade? Delta. That's why they hedge. And what's your biggest risk? Well, probably delta. What's your biggest risk on executing the trade? Absolutely delta. Because if you put in a trade in the middle of the market to buy and the stock goes up or down, depending if it's call or put, and now the offer's higher, you end up chasing the offer. So the smaller the delta on your trades, the better chance of middling. And especially with spreads, because market makers get an edge or a theoretical value on each leg they trade. If it's a single leg, buying or selling a call or a put, well, that's one theoretical value. There's a vertical spread, buying one call, selling another one, you can get theoretical edge on both of them. So they don't have to be as big of a piggy. They can be more accommodating and concede the bid-ask spread a little bit more to you. All right, friends, that's all I have for today. Good class. Next week, we're coming back in full force. How to use unusual options activity in your trading. That is a super important one. All right, friends, I will see you next week on Tuesday. Trade smart. See you next time. Bye.